Hi friends, Dr. Joe here. I hope you all are doing great. And welcome to this new video. In this video, we are going to discuss how to average a trade. Yeah, averaging, I'm sure you must have done it, right? Averaging is something that every trader tries sometimes because they do not want to put a stop loss. They feel, no, I'm right about the direction, only the price is moving a little bit against my trade, and then later on it might move in my direction. So instead of exiting a trade, a trader puts a second trade below the original trade. And many times this happens that a trader want to enter into a short-term trade, an intraday trade, and then eventually what happens? The trade gets converted into a long-term trade. And then the trader says that I'm holding the position. I'm taking the delivery of the stock. And then that converts into a very, very bad trade or a very, very bad investment. Averaging is a strategy. It does not mean that averaging is bad. You must know how to do averaging. You have to learn how to do averaging. And if you do averaging the right way, there can be many times that whichever trade you have entered can get converted into a positive trade. Yes, but you need to learn to average. Averaging is a planned activity. It is an art. You have to be very, very calculative when you are planning to average your trade. It is not an impromptu decision. Averaging is something that you have to plan in advance. So when you see a uptrend, you see that the moving average is in the upward direction. Then you have to start planning. Step number one is understanding all the support levels. If you enter at support zone one, what if the trade goes bad? Where do you enter the next trade? What is support zone number two? What if that trade goes bad? Then where do you enter your third trade? So, first is planning your support zones in case of a buy. The second planning that you need to do is planning your risk. Say, example, you have decided that in this particular financial instrument, you're going to risk 5%. Then how much percentage are you going to risk in the first trade? How much percentage are you going to risk in the second trade? How much percentage are you going to risk in the third trade? And at which level you're going to give up? That is also very important. That means when you have lost all your 5% in that financial instrument, where is that point where you're going to exit all the trades? Everything has to be planned. So, for example, if you have decided to invest 5% in a financial instrument, then your different entry points can look something like this. Trade 1, 0.5%, trade 2, 0.75%, trade 3, 1%, trade 4, 1.25%, and trade 5, 1.5%. So total, you are risking 5% of your equity in this one financial instrument. And if all the trades go bad, you should know where you're going to exit. So let us take an example and see, once you see an uptrend, what are the things you have to do? And then at each entry level, how you're going to plan your entries. So let us have a look at a simulation chart. So here you can see a chart where the price has come down to a good support zone and then the price has gone up from it. Now you think that the price is going to come down before it go up once again. So you have support zone number 1, support zone number 2, support zone number 3, support zone number 4, and support zone number 5. Now when the price retraces back to support zone number 1, because it is an uptrend, you can enter here with your first trade, with your risk as planned, 0.5% of your equity. If this trade goes bad, then your next entry is going to be at support zone number 2, which is 0.75% of your equity. If this trade also goes bad, you enter at support zone number 3 with 1% of your equity. Now, even if this trade goes bad, you have to be a bit careful at this stage because remember, now the price has gone below your 200 EMA. So it can be risky, but still, since you're planned, you should be okay with it. So support zone number 4, you will enter with your fourth trade with 1.25% equity. And if this trade also goes bad, then you are entering into your last support zone, that is S5, Remember, S5 is the lowest point of that particular trend. If the price goes below this, you're going to exit all your trades with your 5% loss. So this is the fifth support zone where you are going to invest 1.5% of your equity. And at this stage, you have invested all 5% of your equity. If this trade goes bad, leave that financial instrument and look for opportunities in another financial instrument. Now, putting stop loss. Putting stop loss is also very, very important. Whenever you are putting a stop loss, your stop loss should be below the next support zone. So, for example, if you're entering at support zone number 1, your stop loss should be below support zone 2. Now, if you use this strategy, your lot size will be much bigger. And of course, you can use the position size calculator whenever you are using this strategy. The second type of strategy is you put all your stop losses below support zone number 5. Here also, you can use the position size calculator to calculate your risk. But remember, when you're putting your stop loss below support zone number 5, the lots that you're going to enter will become very, very small. But it's okay. It's a part of the strategy. You have to plan, you have to calculate, and you have to put your trades. Remember, trading is not just buying and selling. It is calculating your risk at every single entry point. So friends, I hope that this video has made it very, very clear that averaging is an art. It is not an impromptu decision that you enter a trade and then keep averaging. If you plan to average, you have to plan in advance. It's an art form. It's a very, very calculated trading strategy, which you have to understand and then trade. There are a lot of traders who do not understand what averaging is. They become successful once or twice, and then they blindly start averaging their trades, and one fine day find themselves in such a position that they blow off their account. Use this strategy which I have shown in this video, and you will surely find success while trading. Remember, trading is very, very risky. Investing is also very, very risky. So do not invest or trade with those funds which you immediately require. Only use those funds where you know that you're not going to need these funds for a very long time. Risk management and discipline is very, very important. The only people who can be successful in the stock markets are the people with a lot of patience, who practice, and who has a lot of persistence. Friends, if you love the way I'm creating this content, please like and share these videos. So like you, there might be many others who want to learn trading and different trading strategies. These videos will surely help them to learn these trading skills. And friends, if you're still not subscribed to my channel, kindly subscribe to my channel and ring the bell icon. Every time I see a new subscriber, it motivates me to create more such videos. That's all in this video, friends. Have a wonderful day. Thank you. Namaskar.